And I do think that 2021 is the year we start to see significant inflation.
Hey everyone, this is Elijah K. Johnson with the Miles Franklin Market Update. And with us today is a very special guest, Ross Norman. He has 35 years experience in the gold industry, and he also runs one of the top precious metals websites, Metals Daily, and he's one of the top gold forecasters. Ross, thank you so much for joining us today.
Thank you.
Now, the first topic I'd like to discuss is obviously precious metals and the recent rally we've been seeing. Now, some people are saying, well, this is just kind of a bounce and we might be headed lower. Others might think that this is just, the continuation of a bull market and we just saw a little dip down. Where do you see we are right now?
Gold is a bit like a ship. It has a righting or correcting force to stop the boat tipping over. A boat has a keel. Gold has got scrap. You've got high prices. You've got physical markets drying up. So it's got a righting mechanism. And what we're seeing is that righting mechanism putting gold back roughly on track, which is why it doesn't do a Bitcoin. We've had a 23% year-to-date gain after a 19% gain last year. Really solid. But we don't do 70, 100% gains. In short, the market's done really well based and reflected deep-seated concerns, not just about the virus, but the effects of the virus. We know the story. In terms of the recent price strength that you addressed there, I believe you tell more about the man, about how he behaves under adversity, than how he behaves when things are good. We can all be good when it's good. And you tell more about a market from how it behaves when it's under adversity, when you get short selling, stops coming in, etc. How much balance is there in gold? And the answer is, at first, actually, gold was on the floor and didn't behave particularly well. Wasn't that impressive? We had a 6% decline in gold after the Pfizer announcement, and we had a 2.5% gain, and it struggled and it mired after that. In short, gold is now starting to pick up. That righting mechanism is coming to play again, and you're getting physical demand coming out of India and China. Those markets which have been largely absent for most of this year are finally coming good. So gold's got a floor, but it hasn't yet got the energy or the exit velocity to take us back to those all-time highs. So that's something.
Definitely. And we've seen throughout different years in the gold market, I've heard, maybe the last 5 years, we just had our President Andy Schectman on the show, and he was saying, this is a very predictable trend we see kind of leading into the end of the year with precious metals rising.
Yeah, you mentioned end of the year, and that's a key component too. It used to be that Q4 was the weird period because you had, it's a strong seasonal time for buying. You've got Diwali in India, Christmas, and then Chinese New Year. So seasonally, it's a very strong year, point of the year. But conversely, it's also the time when people take profit, particularly in the financial markets. So paper gold is sold and physical metal is bought. And the reason it's that you take profit at year end is, there's a saying in financial markets, a profit isn't a profit till it's taken. So, bonuses in March, paying out in March, why not? Take your profit. So we used to see a little bit of that profit taking outweighing the physical buying. And so Q4 used to be fairly weak, and then Q1 would be very, very strong. In fact, it became so predictably the case that Q4 is now the new Q1. What do I mean by that? Well, because you know that there's going to be new asset allocations to gold at the beginning of the year, funds looking at their exposure, get in early. If you do buy in late December, you're buying your metal conversationally at 5% below what you'd be paying in January when everyone else starts to put their allocation into gold. In short, it's a bit of a mixed period of time. When you've got strong physical, you've got long liquidation in the physical in the paper markets, and you've got new entrants coming in as well. And you've got thin markets as well because people are thinking about Christmas. So you'll tend to get a bit of price volatility because of the lack of liquidity out there in Christmas. Hard to read it in short, and it doesn't mean very much what happens in December. It's just a very mired period of time.
Now, we're seeing in the U.S. some talk about stimulus coming as soon as this week. What is your perspective on how that might impact precious metals?
Yeah, good question. I think today we saw not the approval for, but the near approval for 809 billion, much less than my understanding the Democrats want to push through, roughly half what they want to push through. And then on top of that, of course, you've got the infrastructure spend, the Bidenomics, which is yet to come in the first quarter of next year, assuming all goes according to plan. And it's interesting, as soon as it became clear that a stimulus plan is going to go through, gold has had a lift today. It's currently up 1.5%, up at 1865. So gold has got an immediate knee-jerk response. What's curious to me is, why is gold responding so vigorously on a stimulus? Now, you could argue that it's inflationary down the line. You could also argue, of course, that if America spends money on stuff, not individuals, but on infrastructure, roads, education, and so on, actually that should be economy positive and by extension gold negative. In other words, the fact that gold is going up as the stimulus spend goes up tells you that people's eyes are really rather more focused on the inflation story than they are on the growth story some years down the line. They might also believe that the growth may never come. If they're going to spend it on bankrupt state councils and so on, well, that's just, frankly, from a gold perspective, unproductive and not going to help with growth. In short, gold does seem to respond positively to additional fiscal spend, and we thought it might. And I don't think we're seeing the end of that. We'll see a lot more of that in early 2021.
Right, and you talk about inflation. One of the big indicators of that is the dollar index. We've seen the dollar now at a 2-year low, right? So it just seems very, very positive for gold.
Well, count your shopping basket early next year, Elijah. No, I mean that genuinely. Look at things you might ordinarily buy. Grains, the grains index is going through the roof. Oil is firm. You look at the equity markets. If you wanted to see, there are signs of inflation, and I don't think it's yet fully filtered into your pocket. You might go to the supermarket and spend and look at the spend. House insurance, I mean, that's the thing that's topical for me today. It's gone through the roof. And you should make a mental note for the number of times you have those uh-oh moments when you went, how much? And I think you'll start to see those more and more regularly during 2021. Stealth inflation coming in if it's not apparent to you. And when you start to see that, you know that something's afoot. And I do think, we've talked about inflation, but the best part, well, since 2008, frankly, it didn't come through. We worked out why. It went to basically to prop up vaguely solvent banks. It went to their bottom line. It didn't increase the quantum of money didn't increase, and the velocity of money didn't appreciably increase. But when lockdowns end and stimulus spend goes into the pockets of working class people, you will see it coming back. You will see the spend coming up. You'll see the real impacts of fiscal stimulus coming upon us. And I do think that 2021 is the year we start to see significant inflation. And a last word, if I may, Elijah, on inflation. Some years ago, Credit Suisse did some research on inflation. Now, you're too young to remember double-digit inflation. But Credit Suisse showed that when inflation gets above 3%, gold goes through inflection. In other words, 20-something% increases in gold each year, compounded, will become the norm for as long as that environment happens, like we saw in the 1970s. So if they start to lose, I think they'd like a little bit of inflation. They don't really like to let the demon out the box because it's very hard to control. It creates quite a lot of social friction. Your salary and so on is constantly running behind real costs. So there'll be a lot of social discord with inflation. It does cause a lot of problems. It's very hard to switch off as well. My sense is, if you're going to put inflation on, you put it on hard and you take it off quickly so it doesn't become endemic in the system. And that's what I think policymakers are considering.
To kind of let inflation run a bit, but then really, really pull back?
Correct. Otherwise, it becomes the norm. And salaries. I mean, that way you have that shock factor. That way you reduce the size of the stimulus spend. Now, the real question is, how long will it be till lockdowns occur? What state is the economy in? Are businesses just waiting to get Christmas out of the way for a last hurrah before declaring themselves bankrupt, particularly the leisure industry? I don't know the answer to that, but I certainly know, anecdotally enough, businesses in that sector to know that they are bleeding at the neck, and frankly, they need a bit of let up here. And those smaller businesses aren't getting the support. The big businesses are. And it's the small businesses that employ the majority of people. So certainly in Europe, those small businesses aren't getting the support that they need, and they've had since March, and it's remarkable that we haven't had a massive escalation of bankruptcies anyway. In short, I think we're not out of the woods. The gold price is reflecting that in part. It's had some bad news too. There are some bad news about gold, and we should maybe, if you want to, look into those as well. But it's not all rosy. Year to date, 23%. Who's complaining? Next year, probably a bit better even.
No, you talked about the UK as well. Do you see inflation happening there as well, just like in the United States, as things start getting up and running again?
Yeah, no question. I mean, I don't know if you do the shopping for your household, Elijah, but you have those moments, and as I said to you, you count those moments. Absolutely. I mean, on paper, theoretically, the CPI, as you call it, or retail price index, is relatively benign, just above 2%. But I think that it's, as I say, when we start to ease up these lockdowns, you're going to start to see an escalation in inflation. Are we going to see double digit? I don't know. The answer to that, you'll find better economists than I on the program to talk about that. I just have a sense that we're going to have a bit of an inflationary binge during next year, maybe for a year or two, and then I think they'll try and pull back from that rather than let it get set in the system. We like a quick reset. It's like doing job cuts. Best off done quickly and firmly and move on than allowing it to extend over years and months.
Now, you talk about inflation and the signs that are bullish for gold. What about some bearish signs that people might want to keep looking out for?
Absolutely right. What's the other side of the story? The other side of the story is 2020. If you were writing a story about it, a good year for us in gold. In the first sentence would have to appear the word ETF. In the first 6 months of this year, we had more buying in 6 months than we've seen in any previous full year. It was a record year. Recent years have seen incredible central bank buying. Both of those primary drivers of gold have significantly weakened. In fact, we've seen some net selling from central banks. And ETF demand has come off significantly. So those Western institutions that have panicked and bought heavily into gold, those central banks who have been buying and driving gold higher, filling the vacuum that was left by the absence of Indian and Chinese demand, those key drivers have very much lessened. And of course, with record prices in gold, as we saw in August, we've seen huge amounts of scrap coming to the market. So you've got scrap, you've got weak ETF demand, weak central bank demand. In short, the market writes itself, as I say, like a yacht. After a 19% gain and a 23% gain, scrap comes into the market, particularly from Asia. We saw it in Malaysia, we saw it in Thailand in particular. People thought, these are crazy prices, I want to sell into that market. And they did so. So these writing mechanisms have come into play. For me, the factor I'm looking at more than any to tell me whether gold has really found support, really found a bottom here, are the local premiums or discounts to the London market in India and China. Now, China's particularly good because it's a lobster pot. Metal can flow in, it can't flow out. It's its own market. It's a very large market, the world's largest. And gold in China has traded at a $70 discount to local London. In other words, they weren't buying at all. We had record prices in both of those countries. And so we ain't playing. And the market was taken away by institutional investors. Now the market's come back, they're starting to buy. And that discount has shriveled. It actually went to a small premium recently and off again. So to me as an investor, I'm less interested in how much am I going to make than how much am I going to lose. Where is the real floor? And I sense from what India and China are doing at the moment is there is a floor there, and Dubai comes to this story as well. There's a floor there, and it supports the market. And it gives you a sense of where fair value is for gold as well. My sense is that gold has found a floor. We had a significant amount of profit taking after Pfizer's announcement. We saw stops being triggered. We saw people piling on, shorting the market because it was headed lower. The market ground out a level. Now that demand's coming out of Asia at last. In short, though, when you weigh up the positives and the negatives I mentioned, the flows out of ETFs to central banks and the appetite and the inflation, The market feels like it's in some kind of balance at the moment. We're also in a weird period of the year. We'll see some allocations in January, and I think it'll be a fresh start. At the moment it feels balanced. 23% feels right for what we've seen. And then we'll start with a fresh book on the 1st of January. We'll be looking at what President Biden intends to do about the fiscal stimulus. We'll be looking at inflationary numbers ourselves, looking at our shopping baskets. What are we really looking at here? Those are the sort of issues we'll be looking at. We'll be looking at trade policy. We'll be looking at Brexit, how that's played out. We'll be looking at China relations, much of those factors. The other key drivers, so I'm doing all the talking here, Elijah, are US Treasury yields. Arguably, gold has got the strongest relationship there. And Treasury yields have been edging higher, but so's inflation expectations as well. So the real Treasury yields are still negative, but a little less so than they were. That will remain a very important component. US government bonds trading negatively, even corporate bonds trading negatively as well. So those are the sort of things we'll be looking at next year. Inflation will be right up there. Do ETF demand reflect what we're beginning to see again in inflation? Was that correction in central banks just a moment in time? They really love it still. Is India and China going to continue to provide us support in these markets as they become unlocked? Are they going to re-engage? What's the local premiums or discounts there to tell us the market is well supported and therefore can spring higher? And the other thing to look out for is the shoe shine boy moment. That moment in time where we saw Robin Hooders getting in behind a market which gets too hot. And I think we've had a good washout from, let me call them the weak hands, the gold tourists, who got unfortunately smacked rather badly in this correction. But you know what? Memories are short, and they'll be back.
No, with respect to like price predictions and things like that, I know you've said in other interviews that it really doesn't, the number isn't what matters. It's the argument, the underlying argument behind it.
Yeah, absolutely. Absolutely. I have the record as being the top forecaster over 22 years. And sorry if I sound arrogant here, I will win gold and silver again this year, putting me embarrassingly at the top. And Elijah, I know nothing. And I mean that genuinely and with great humility. It's a guessing game where the odds are very light or very heavy. In other words, the degree of probabilities change quite significantly. My advantage over, shall we say, rather more serious analysts is I stand in the flow of fast-moving information. And it's no longer supply-demand dynamics, in my view, that drive market, and it's the madness of crowds. So having a feel, I'm afraid, it gives you a better view. In other words, there's no magic science attached to the art of forecasting. What really matters is who are you and what do you expect? If you're a gold trader, then good luck. It's a tough world. Certainly under the Trump administration, markets were moving on a tweet, which were very hard to predict, and therefore you couldn't really read a market, except know that it was vulnerable and therefore gold friendly, but you couldn't really read it. You have some views. As a gold investor, your time horizon is much longer, and therefore the issues that you consider are more fundamentally based, and they're more knowable. So an investor has got an advantage. Is there going to be an inflationary crisis in the next 5 years? Yeah, I reckon so. Well, what's the chances? 1 in 5? If that's the case, 20% of your assets into gold. That's the kind of thinking you should have. I wouldn't overcomplicate it. So depending upon who, what you are, what you think, that's the most important thing. And then the next thing, what you need to do is engage your view of the world with other people's views, clash the arguments, and maybe they'll modify your opinion a little. That's about as far as you can really go on forecasting. There's no magic to it, really. Sad to report.
All right. Well, Ross Norman, thank you so much for joining us today. Before we let you go, if people would like to find out more, they can go to metalsdaily.com. Any last thoughts you'd like to add?
No, Elijah, it's always been a great pleasure talking to you as well. And thank you for your time.
Thank you so much, and God bless.
Thank you.